today, tomorrow, but maybe a year from now. Nilesh Shah, MD Kotak AMC, joins in on the show right now. Nilesh, hi, good morning. Great to have you on 80 now. Nilesh, what's the market looking like? I mean, it's a conundrum really out there. So many macro as well as micro factors at play.
Undoubtedly, Aisha, right now, the mood of the market is slightly cautious. There has been relentless FPI selling. They have been saying for 1 year, your markets have given negative return. Last 5-quarter earnings growth has been in single digit. US tariffs and US policies will create uncertainty for India. There will be fear in the minds of certain investors based on this data points. On the other hand, there are local investors, domestic investors, who have made money over 5 years, who are willing to pay waiting game, and who will be interested in long-term India growth story. This is the battle between fear and FOMO. If FPIs is able to create fear in the mind of DIIs, then certainly there is more downside to the market. On the other hand, if DII is able to create FOMO in the minds of FPIs, there could be bottom making and there could be upside in the market. Ultimately, India growth story will be linked to earnings. As earnings growth accelerates, which is more like a FY21 story, we will see market stabilizing.
Sir, sir, this is Harsh also joining in. Give us a perspective. Do you expect a very strong rebound in earnings in H2 FY26 given all the measures that have been taken? And is there a case for a larger rate cut possibility going forward? Do you see that?
So RBI has pumped liquidity. They have cut interest rates by 100 basis points. Transmission to a great extent has also happened. Now there is room for further rate cut, keeping in mind lower inflation trajectory. It is up to RBI whether they give a positive statement saying that RBI could cut interest rate in the days to come, or it could actually give rate cut. I think more than the rate cut, the communication will have material impact onto the sentiment and the market. In terms of September quarter, there will be some impact of the GST announcements. Between 15th October to 22nd September, people deferred their consumption in anticipation of rate cuts. And 22nd September onwards, there was a spike. But will the 8 days of September be good enough to cover for about a month plus of deferred consumption? I don't think so. The second half, FY26, certainly should be able to deliver better earnings than the first half. However, the momentum which consumption will build is more likely to be reflected in FY27. We have income tax cut, GST cut, interest rate cut, and 8th pay commission coming into play. We have steps taken to negate adverse impact of US tariff through stimulation of domestic economy by finding alternate exports market and also engaging with US to find out a solution. So I will say earnings growth is likely to be FY27 story rather than FY26 story.
Right. But Nilesh, just going back to the point that you were making, I mean, the government, the RBI, the entire machinery is doing all the right things that it can. The broader market has been opening up very nicely with a flurry of IPOs there. What will make the FPIs FOMO eventually?
So essentially, what is in our hand is to deliver. We have to deliver on the 3G of earnings growth, governance, and taking care of green environment better than our peers. Last 5 quarters, our earnings growth has been in single digit. Certainly with that single digit earnings growth, we can't sustain 20 times plus valuation. I don't think so. It is in our hands to convince FPIs whether they should buy or sell. We should simply focus on performance, and we should convince that yes, India might be the expensive emerging market on a 1-year basis, but it is the cheapest emerging market on a 5-year basis because of the superior earnings growth. In last decade, Chinese CSI 300 index earning growth was about 10%. Their EPS grew by about 10% in last 10 years. Our earnings growth in the same time period was 180%. No wonder, while we underperform China on a 1-year basis, on a 10-year, 15-year, 20-year basis, we outperform massively. Our focus should be now on next 10 years, how we grow our earnings better than China. Then FPIs will come back.
Sure, makes sense. But Nilesh, in the very near term, where do you think the earnings revival can happen? I mean, can the GST rationalization really be that sort of magic wand that can up the demand to that degree?
I don't think so. GST alone will be magic wand. More important is how do people spend money? There is 1 lakh crore given annually in the pockets of taxpayers. The GST collection is giving 50,000 crore in the pockets of consumers this year. But if we take into account bottom of the pyramid, they are getting benefits of 1 lakh crore. And next year, that shall be 2 lakh crore. Of course, there will be some consumers from whose pocket 1 lakh crore is taken, but they are at the top of the pyramid, and hence that outflow is unlikely to impact their consumption. Interest rates have been cut. That again puts close to a 1 lakh crore plus in the pockets of borrowers through lower EMIs. And 8th pay commission is coming into play. Gaming has been banned. That's going to put more money in the pockets of people who were addicted to gaming. We could probably see some limitation on FNO. That also will leave some money in the pockets of speculators. Collectively, Indian consumers, be it a taxpayer, be it a consumer, be it a loan borrower, be it a speculator, will have close to 4 to 5 lakh crore annually getting added to their pocket. Now, if they are going to spend this money on going on, let's say, foreign trips, then economy doesn't benefit. But if that money is going to be spent on Swadeshi, goods manufactured in India and whose benefits will remain in India, certainly economy will benefit. So GST collection per se is not the magic wand. But if the people of India, citizens of India, unlike demonetization when they didn't disclose their black money, but find out ways and means to hide that black money, response to Swadeshi, then it will be a magic wand.
Fair point. But Nilesh, one is wondering right now as to whether you need to rejig your portfolio, ease off on capex, increase consumption, increase defense. Do you think that kind of a jugglery needs to sort of happen?
So obviously, Aisha, you have to build your portfolio according to how you believe valuations are and how the earnings growth is. Thumb rule wise, cheaper valuation and better than expected earnings growth will be a winning combination. Very easy to say, far more difficult to execute. On the defense side, we believe valuations are quite demanding, and hence one will have to be careful on a bottom-up basis. Go for those defense companies where they have spare capacity, so operating leverage can kick in. They are catering to local as well as global markets, so their order book is not constrained by the Indian budget. And finally, they should be in futuristic warfare rather than old warfare. Undoubtedly, the rules of warfare are changing, and companies which can provide tools to capitalize on the same will do well. In terms of consumption, Aisha, again, we have been bullish consumption for some time. Our top pick within equity was consumption fund. And this is consumer discretionary, which is expected to do well. as all the money left in the pockets of consumers is unlikely to be spent on consumer staple. Roti kapda shayad sabke paas hai. So the spending will happen on hotel, tourism, travel, home improvement, and so on and so forth, kind of experiential thing. So your portfolio should be overweight some of the consumer discretionary names. We believe that sector will outperform the market in the days to come.
Got it. How do you look at some of the export-facing names, Nilesh? There's some bit of headwind where tariffs are concerned. You believe that's temporary? Are these opportunities to buy actually? I mean, you have well preached multiple times that, when you're at the height of pessimism is a great time to buy. IT, pharma, are some of these names starting to crop up or probably already on your buy list? Is that something that would look attractive to you at this point?
So in our select funds, we have been looking to accumulate IT. That's primarily driven by, one, these IT companies are able to leverage AI to deliver cheaper, better, faster solutions to their customer. Second, they are focused on enterprise AI, where corporates will require data arrangement and then securing that data from the outside world despite using AI. We believe enterprise AI is likely to be a fairly large field, as much as probably the current IT services business. Companies which are capturing opportunities over there should do well. Obviously, this is the phase of accumulation. And to some extent, in a very, very short period of time, maybe a quarter or two, if currency depreciates, there could be some benefit to the IT services company. The real issue here is US policy. Will they realize that Indian IT services company have provided a lot of software to US and they don't have to worry about cybersecurity or virus risk? If they had procured it from any other country, their vulnerabilities would be open out in the market. So clearly US policies towards IT companies, IT sector, keeping in mind their security will be very, very important. So we are in an accumulation phase in IT. Slowly but steadily, we believe the dividend yield, the rupee depreciation, the enterprise AI market, and ability to leverage AI will create bottoming out of IT stocks.
Interesting take there, and especially on IT. Nilesh, always good having you on the show. Thanks for your time.
Thank you.